Ray, you recently released a very interesting note suggesting that for the first time in a long time, our corporate clients of RMB should be looking at fuel hedging once again. So take us through your thinking.
Well, John, I think the spark for the idea came through when we saw quite a few news headlines around potential diesel shortages in the US. That was coupled with quite a big move on the New York Harbor diesel contract, actually touching $400 per gallon at one stage. Could have a few guys wringing their hands. And as you know, I mean, we live and breathe in a very global marketplace. The feeling was that those sort of prices would filter through into Europe and eventually come through and hit the consumer on this side in South Africa as well.
Okay, so break down the thinking there, because as you know, as you always point out, we used to look at the oil price as an indication of where diesel and petrol in South Africa is going, but it's a lot more complex now. It's a lot more about the refining spread. So just break down the thinking there.
I mean, yes, like you say, I mean, maybe we sometimes fall into the trap of being a little bit too fixated on the underlying Brent crude price. But for quite a while now, our main worry should have actually been directed at the oil product side of things. What we're talking about here are the middle distillates, so your diesel and your jet fuel. This is where we don't have necessarily the same sort of levers to pull in terms of, controlling or managing underlying price movements. You just have to look at the crack spread at the moment between Brent and ICE gas oil. Previously, this was sort of around $10 per barrel medium. But at the moment, the mean seems to be close to $30 to $40 per barrel. So just very indicative that refining margins are going to be very high, probably in this new market regime.
Okay, so a very changed environment, because a few years back you told me oil's at 100, corporate should be locking that in, and fuel prices, I would have said that's too high. But refining margins have changed, and even the outlook for the oil price itself.
Yes, I think there's been quite a big movement, as we all know, on ESG. And with that has come maybe a little bit less investment in your fossil fuel side of things. So there's not really a quick fix in terms of, building new refineries. As an interesting point, the US hasn't built a new oil refinery since the 1970s. So that just shows you that this isn't a fix that's going to come through overnight. And in fact, a lot of experts are saying that this tight low supply market that we're in now with regards to oil and oil products is probably going to be with us for the next 2 to 5 years.
Okay, something my clients always ask me, what about the refining capacity in South Africa? Heard all these refiners shutting down, but that doesn't create a shortage of supply, does it, in South Africa?
Not really, because I mean, we've been living with this movie of, let's say, 10 to 15 years of us not having too much refining capacity here in South Africa. We have been importing most of our oil products, so those sort of events are serious. Yet it shouldn't be too much of an alarm in terms of creating higher prices in oil products.
Okay, and just take us through what type of products our clients can hedge.
So, I mean, maybe first to mention that the typical contracts that one can maybe best protect yourself with regards to higher diesel prices is actually the European ICE gas oil contract. Through some analysis, we found that this has a 92% correlation with our domestic prices, obviously converted to Rand. So that is the best sort of contract to actually look at in terms of protecting yourself against higher prices. Products available on that front, outright swaps, which you can think of as just forwards. And we also offer some options trading as well. Options are slightly more complex, but the desk and our various sales channels will be happy to talk anyone who's interested in doing that through that process.
Okay, so bigger picture view, risk of further upside in fuel prices, clients should be hedging. Last word from you, please.
Yes, I think that's right. I mean, look, as we've seen recently, nothing moves up in a straight line. We saw Brent crude above $100 per barrel. It did come down to $85 per barrel. That was largely due to demand destruction, just the global growth question. But something that I always go back to is we haven't sorted out the supply side of the equation just yet. And without that being sorted overnight, the risks are still pretty much skewed to the upside.